Let's dig in a little deeper on what you heard from President Zelenskyy. I mean, this is a critical time for what's happening in Ukraine. What's been amazing is that their economy is growing while they're in the midst of this ongoing war.
I mean, it's a classic definition of walking and chewing gum when you think about it. They're fighting to the death, and the first time they came in 22, all of us were just stunned by how resolute they were in terms of fighting the war. And on the other side, they've opened the Black Sea so they can get the grain out of the country, and they're producing that in the economy. You know, our teammate Bernie Menza went there on Friday with Secretary Pritzker, and he said, you're in Kiev, you go to a coffee shop, it feels like a normal city, there's traffic jams, and then all of a sudden the missile warning come in and stuff, so it's much different. But, you know, his message was they've got to straighten out the country, and the reforms have to go through while they're fighting a war, too, to get the anti-corruption and the things that they were working on as a country. They have to keep working at it, because otherwise you can't put the money in at the level, so he knows that. And it's fascinating to hear him talk about it, because he's flipping from military defense to, you know, anti-corruption to military defense to grain production to military defense. It's really kind of fascinating.
In terms of the global economy, one of the issues that you've talked about recently, you just came out with earnings on Friday. One of the things you said is that there is less demand for commercial loans. What do you see happening?
Well, so that's more of a U.S. commentary. And you know, at the end of the day, the consumer's been relatively strong. They've held in there. They continue to grow their spending. So demand's there, but businesses have gotten more and more cautious, really facing this question. If you're told that there's going to be a decline in the economy, soft landing, we predict, but still from a 4 to 5% growth rate to 1% growth rate is a steep slowdown. They're being cautious. Their cycle shortens. Their thought process shortens. And so what we need is just to kind of get through this change in the rate structure in the U.S. and around the world. We need to get through a little more certainty in a stabilization at a level, and then we can work out from there. But right now you're in the twist between, you know, a very tight, a rapid tightening of policy, you know, knocking down car loans and the housing industry and things like that as intended. And now you got to come out the other side, and businesses react to that. So their line usage went from 40% pre-pandemic to 30, back up to 36, and now it's bouncing around a little bit low. That against an economy that's growing, you'd expect them to be back up to normal, frankly.
Go ahead.
Sorry, we still see. I don't know about you, but some of your competitors still refurbishing the bank rescue fund. But can we put that behind us? So that really was a one-off. A couple of banks that you know got caught with their pants down in terms of duration risk. But we thought maybe that everybody had a duration risk problem. That was not. Now rates are starting to, they come down. They haven't yet, but maybe they come down. So we dodged that. That was a mini little thing.
Those companies are very unusual companies. They're very different. If you put a 10-point scale of what's a bank is, you know, 10 would be ourselves and Wells and people like that. And if you went to them, they're in the 2, 3, because it was a very different business model, and that business model suffered. And it's been contained. And you know, yes, the group of us, we were $2.1 billion in the fourth quarter to reimburse the fund. And so the FDIC, everybody thinks is the government's money. It's a government guarantee, but it's a bank insurance fund behind it. We pay for it, and we paid for that, for those costs of liquidating those companies. But yeah, that has been behind us, and the rest of the industry is strong. They have a capital. That's why we are not really thrilled with these new capital rules, the liquidity tests, the stress testing we've been doing for 15 years.
No iceberg underneath of hold the maturity of
commercial real estate, because I don't know if you saw it, probably a lot of people back home may have seen it. There's a big 60 Minutes piece just this Sunday, all about commercial real estate. And there were a lot of prognosticators on that program saying, look, all of these things are going to roll, and when businesses actually have the opportunity to get out of their leases, they're going to, and this is going to take the whole market down.
Everybody,
the whole commercial real estate market down, which might have larger implications.
So there's a couple of things that the commercial real estate loan product, for lack of a better term, is more outside the industry than industry, and then in the industry, it's more of a localized product, and so those of us that are larger don't have as high exposure clearly than we ever did. We had 100 billion going into the financial crisis. We have like 60 now, and of that office is like 15. And so, you know, across $1.5 trillion alone, $1.05 trillion.
Are you going to change your own footprint
in terms of?
In terms of your own the real estate, the real estate the Bank of America has, because a lot of people are looking around at businesses saying, 2-3 years from now, when these leases come up, are people going to keep them? Are they going to shrink?
We've shed 30 million square feet of real estate in the last 15 years.
Already,
from about 100 million, almost 40 now, down to 60.
Why? Because you didn't like it?
Just space consolidation, efficiency. There's a long-term trend in the hoteling and all the different office space, and then the pandemic hits, and then we learn about 3 days a week, 4 days a week, and all that. Which actually, make it simple. There's 5 work days, If you have people in the office 4 days, that's either 20 or 25% savings in real estate costs, but it takes you time to get there.
Is it really? Because don't you still need the same space? I mean, if people are coming in 3 days a week.
That's the hoteling and stuff that went on. Remember WeWork and all the different things that we talked about? That went on before. That trend line was already going. What happened was we only got about 25% of our space positioned that way. And then the pandemic hits and everything changes. And now you can go do the rest. And that's the long-term trend. The commercial real estate, look, at the end of the day, the revaluations are going through as we speak. And you're seeing that come through provisioning and reserves and charge-offs. But it's relatively modest. But it takes a long time because this is a slow burn of change as opposed to, as Joe talked about, 5% rate rise in 12 months. That's a quick change.
But if it's not a problem for you and some of the other big banks, is it a potential problem for some of the smaller banks that do focus much more heavily on commercial real estate? And what does that mean for the FDIC and the potential assessments down the road?
That's where I say these are. If you were around in the late '80s, which I was, the commercial real estate and the real estate issues around the country, those things are slow liquidations. The system knows how to handle that kind of bank failure. There's 4,000 banks have failed in the country over the last 40, 50 years, so it's not a big event. And most of that concentration, smaller banks, they'll be fine. And they know the clients. It works through local communities. And so, yes, it's going to be disruptive, but it's a little different than if you have what we had in the financial crisis where the whole mortgage industry went kapooey overnight, and that affected all kinds of things. It's just the leverage is not quite the same.
You believe in the market's forecasting of how many rate cuts we get next year? And the reason I ask is there's always a worry about crowding out of the private sector at $34 trillion. Yeah. And it started happening, and then the supply was too much and the auctions weren't going well. Suddenly, we're going to get everything's fine, 6 or 7 cuts, no more worries about that. We're clear sailing.
I wish the day that you all would stop talking about the Fed and they would be off to the side and the entrepreneurs and the capitalism.
They won't let that happen.
Because at the end of the day, the U.S. economy drives by you're going to have 80 CEOs, I think, over the next year. They're going to talk about what they do and how they invest. That's what drives the U.S. economy. And so the Fed's got to get normalized and then get out of the way. But if you think about, we have 4 rate cuts, not the 6 or 7 in the market, for this year, 24, 4, and 25, which leaves you the 3% plus Fed funds rate, probably have a 4 handle on a 10-year. That'd be a normal rate curve for those of us who have been around a long time. It's just for the 15 years or so since the financial crisis.
You've been around. Yeah.
Nobody's seen a normal rate curve. So it's going to take a while for the system to adjust to that. The reality is we got to get there. We got to get the rate structure in a way that has more flexibility up and down, is not so glued to the floor that we can't get up. And so I think you'll see that play out. Hopefully that'll play out because that would be better for the U.S. and ultimately better for all the countries around the world if we can get the U.S. sort of situated with a dynamic of growth and inflation that's much more normal. And that's what the Fed's trying to engineer, and they got to be careful they don't overshoot right now.